Okay, so my first video of today's series, I always do a playlist, which, by the way, new people, you may not know this, new subscribers. In my description box on these videos, there's a link. It's usually the very topmost one, and it says today's playlist. If you click that, it'll start from video 1, 2, 3, whatever. That way you don't have to go back and find my next video. It just will play right for you. This is definitely a 3-video day. I may have a 4th one because there's 2 things that I really need to talk about. But this one is from Wolf Street. Matter of fact, the next thing is also from wolfstreet.com, Wolf Richter. Guy's got he gets the data, man. This guy's great, just like Zero Hedge. I love them. My first video of today, so this is my 3rd one, right? My first one, I've talked about the housing stuff and all that. And I showed you the little chart with the little lines intersect and all that stuff, saying the last time that happened was, 2006, 7, and then 8 happened. Look how it ended. We're at that intersection again right now in 2017. Just happened this month, May. This goes right in line with this, by the way. In his title of his article, Commodities Bust. Because remember what commodities are. Not just gold and silver. Oil, wheat, corn, etc. Those are all commodities. They're played on the commodities market. Commodities bust hits farm lenders. Delinquencies surge 225%. Is that a sign? Or just a little one-off? Just as the deflating farmland bubble leaves its marks. When it comes to agricultural debt, the numbers aren't huge enough to take down the global financial system. But this shows how much pain the commodities route is producing in the farm belt just when the farmland asset bubble that took 3 decades to create is deflating. And what specialized lenders and the agricultural enterprises they serve, some of them quite large, are currently struggling with in terms of delinquencies. This is what delinquencies on loans for agricultural production, not including loans for farmland, which we'll get into a moment, look like. And again, I'm going to show you this because you got to see this. Again, this right here, this goes back to 2005, okay? 6, 7, 8, 2009. What happened at the end of 08 and 2009? The big Great Recession. So that's when this went above this line here, right? Went way up here, came back down. Do we have it under control? Maybe. Looks like it. Okay, it's back down again. Oh, wait a minute. 2013, 14, 15. Here we go again. 2017, guess what? Touch the line again. In between here, as it says, 225%. Okay? Again, if you're looking to buy a house or anything, hold on. You're going to find deals of your lifetime. It may take 1, 2, 3 more years, possibly. And I'm going to say possibly at the very latest. From quarter 4, 2014 to quarter 1, 2017, delinquencies have soared by 225% to $1.4 billion, according to the Board of Governors of the Federal Reserve, which just released its report on delinquencies and charge-offs at all banks. This is the highest amount since quarter 1, 2011. Remember, that's when that was like when the key time to buy a house was. Lowest price ever, 2011, barely into 2012. That was like the bottom. So this is, as I said, this is the highest amount since quarter 1, 2011, as delinquencies were falling after the financial crisis, right? Because we had the financial crisis, delinquencies big, then it started to fall. 2011, 2012, as I just showed you in the chart. Then next thing you know, 2013, 14, 15, great, they're back up again. Again, I'll say this until I'm blue in the face. Nothing, I repeat, nothing was changed or fixed since 2008. It has only been made worse, bigger, greater, and not in a good way, okay? So I would expect a bigger housing bust. But even if we have a housing bust similar or identical to what it was in 2010, 11, 12, as far as the absolute low, I'd be okay with that. Would you be okay with prices falling in half right now for houses? I'm sure you'd be okay with that. And so would I, and that's why I'm waiting. So anyways, this is the highest amount since quarter 1, 2011, as delinquencies were falling after the financial crisis. That amount was first breached in quarter 4, 2009. The delinquency rate rose to 1.5%, the highest since quarter 3, 2012. On the way up, going into the financial crisis, delinquencies breached that rate in Q1 2009. These were the loans associated with agricultural production. In terms of loans associated with farmland, delinquencies have soared by 80% from Q3 2015 to Q1 2017, reaching $2.15 billion. So that we're only talking, they've soared 80% from the end of 2015 to the beginning of 2017. So you're talking like just over a year. Delinquencies of farm loans. And again, look at this chart. I have to pull this back up. There's another one. Delinquencies of farmland loans. Again, real estate, right? Farmland. 2005. Over here. 6, 7, 8. Crisis. 2009. Delinquencies. Yep. Everything's been foreclosed, sold off. Okay, this is the aftermath. Goes back down, goes back down. Once again, same time frame. End of 2011, 2012. It was actually over here. 2013, 14, 15, 16. We're touching the line again. Oh, man. How do you suppose this is going to end? Farmland values have surged for 3 decades, but are now in decline in many parts of the U.S. Let me just stop for a second. I would love, and I'll say this again, Alabama has some really, really good prices on real estate. I'd love to go and say, you know what, guys? Remember how I always talked about the day was going to come when silver was going to explode and Bitcoin and all these coins explode, and maybe I'll sell some or both or whatever and buy this beautiful land property. You know, it would be really nice to have, quote unquote, farmland. Not just some house with 2 or 3 acres, but actual farmland. It's already got the barn, you can grow, all of it. Just, again, farmland. And say, oh, that's my beautiful house over there. There's my mama's, my papa's, or my papa's house, and my sister and brother-in-law. Come on over. Put your houses up. Family unit, this is ours. That's what I want to shoot for. Move the family in. You have each other's back. You're all in the same land. But unfortunately, in my case, Jason 4 is going to own it. Jason 4 will be owning it. But yes, you can put your house, and I'll cut off a little acre for you that you can technically own. That's yours. But it'll be on the same main piece of property. That's what I'd love to have and show you one day. Guys, I'm making it happen. It's been years, but I finally was able to do this. As you know, you saw the price of silver. It exploded, and I sold it all off, whatever, because I saw this beautiful piece of property. And I saw this house in Alabama. I think it was near Dothan, or Dothan, how do you say that? D-O-T-H-A-N, Dothan. It was around $800,000 or $900,000. Okay, that's out of Jason 4 range. But when I saw the picture of the house, it was like an absolute textbook big mansion. Beautiful backyard with a pool with a little streaming water. I'm like, this is a multi-million dollar house anywhere else. It was on 50 acres. It was beautiful. I thought, not that I could afford it, but man, that's a fire sale deal now. And the prices are, and the price of everything is high right now. What I love to be able to say in a little while, as in maybe the next year or two, oh my God, guys, that $800,000 house that I told you about, 2 years ago, it hasn't sold. They want half. They want $400K. And because of the price of silver today, and this and that and whatever, I'm going to put a huge down payment down, if not buy it all, right? And I'll be able to get a mortgage on a little bit of the rest. Boy, would I love to come out and tell you that. And I'm telling you, there are going to be some deals of literally a lifetime that are going to be better than the deals you saw in 2010, 11, and 12 during the peak of the horrible housing price market. It's 2.0. I've been saying this. I'm trying to prepare people in advance. The crashing market is coming, housing. And of course, other markets as well. But we're discussing housing right now. Anyways, farmland values have surged for 3 decades, but are now in decline in many parts of the U.S. For example, in the district of the Federal Reserve of Chicago, which he calls Illinois, Indiana, Iowa, Michigan, and Wisconsin, prices soared since 1986. in some years skyrocketing well into the double digits, including 22% in 2011, which is odd, right? Because 2011, that was the low. What the? And nearly tripling since 2004. It was the great farmland bubble that had become favorite playground for hedge funds. But starting in 2014, prices have headed south. This chart from the Chicago's Fed Ag Letter shows farmland prices in its district in two forms. I'll pull this up. Adjusted for inflation, green line, which is actually this bottom one, and not adjusted for inflation, the blue line. But in both cases, what do we see? Which is interesting because here's the crisis, and nothing really happened as far as farmland goes, right? And then again, 2015, 14, 15, 16, 17, now we got the downward trend. So not only are we talking real estate, regular real estate and commercial, and I'm not going to include farmland for that, but, office building and then houses, residential, that kind of stuff. Good night, right? We're seeing that starting right now. But now you can include separately farmland, which is, again, funny to me because as I'm looking at that chart, it didn't really move even through the crisis of 2009 and 10. Holy crap. Or 2008, 9, 10, 11, etc. But now it is. So if this is 30 years, as they say, of declining prices, again, all I can think of is Martin Armstrong's chart. Let me see if I can find this real quick. Let me pause this. Hang on. And like old Fire Marshal Bill once said, "Hey, let me show you something." Real estate, the 78-year long wave. Copyright Martin Armstrong. All rights reserved. Again, this is fair use. I'm just discussing news items. 1955, right? 2007, 0.15, which just means the early part of 2007. What did we have happen? 2008, 9. Oh. When did I tell you the best price to buy housing was? That I saw over and over? 2012. It was the end, but then it started going up. So here's 2015.75. And granted, some things you might show that lasted into 2016 too. But again, this is also 2015.75, which is approximately October of 2015. But this down leg, notice these little sawtooth, right? Up, down, up, down, up, down, up, down. But then we have this interesting timeline that goes to almost 2033, right? 0.95, so it's almost 2033. Are you telling me that housing is going to crash so bad over the next 16, 17 years? I mean, first of all, I have a family. I don't want to be buying a house in the year 2033 or 4 to get the utmost awesome deal ever. I need to get one soon. We can't stop living. So it's hard to time these things. So it looks like just housing generally, year after year, when this thing finally hits here shortly, it's just going to be down, 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 down. Like, oh my, what's happening? That's his chart. It's been there for a long time. He's had that thing for years. Hasn't changed. So, other thing, commercial and industrial loans, all commercial banks. Let's take a look at that. Now this one goes back to approximately 2012 to 13. Well, way over here would be 2012, so I can't see 2008. But this chart shows C&I loans outstanding at all U.S. banks going back to 2012. Note how the 30-week stagnation period is unique in this time span. So, since the Federal Reserve, since the financial crisis, the mantra has been credit growth no matter what. Businesses have been exhorted to borrow. Money has been cheap, and borrow they did. Stock buybacks, anybody? There have been periods of 4 or 5 weeks of stalling C&I loan growth, only to be succeeded by a vigorous surge. But after ballooning in this manner for 6 years straight, C&I loans have now languished for 30 weeks. And it's not the oil bust. Banks are lending to the oil patch again. C&I loans are tightly connected to the real economy. They're an indication of what businesses are up to. From a shop needing to a loan to buy a piece of equipment, to the multinational funding its receivables, C&I loans show whether companies in aggregate are expanding their needs and activities or whether they're curtailing them. The chart below shows how any significant decline of C&I loans outstanding in the debt-addicted United States economy is associated with recessions. Note the turning points. Here's the chart for you. 1989-90, tech bubble burst, 2000, last Great Recession, 2008-9. Here it is. And funny enough, here we are in 2016-17 right here. And notice how it's peaked over the mountaintop there, if you will, and it's now coming down. Again, this is what I always refer to as the thermometer. This is a thermometer telling you it's very hot outside. And when you turn on the TV or ask our God, known as government, and their minions, known as the Princeton, Harvard, and Yale economists, and everything, hey guys, that thermometer, what thermometer? I haven't seen a thermometer. What are you talking about? It's cool outside. It's about 70 degrees outside. 72. No, my thermometer says it's 98. It's sweltering, and it's in hot, humid Florida. And by chance, it's July, so it's definitely on. Nope, not 72. Here's our data. The newest data release says 72. So you can be a bozo if you want and listen to that, or you can look at the hard data, like the stuff I present you all the time, like this right now. This is hard data. This is like math, pure math. 2 + 2 is 4, and the Fed's telling you no, 2 + 2 is 1. No, the unemployment rate's like 8 + 8, 16. And they're telling you, no, it's 8 + 8 is 4.4% unemployment. So all these indicators are showing, and do you believe there's only 4-point-something% unemployment right now with these indicators? Not a chance on your life. So not a chance in hell anyways. I got to do one more video. I'm trying to make this one quick.